Let's look at two dividend stocks that have been performing quite badly recently and may be undervalued and at a discount. Remember, this is not financial advice and you need to do your own research. The first one today is an absolute powerhouse of a UK dividend stock, and I would say about 60 to 70% of dividend investors in the UK will have this company in their portfolio, and that is Diageo. Diageo are the company behind many globally known alcoholic brands. I would argue that this company has a very strong economic moat and a consumer base. I personally don't see them going out of business, and if they just stopped being Diageo and the brand just disappeared tomorrow, which I don't think is very likely to happen, but if it did, the shelves would be pretty empty. Like I said, nearly all of their products are globally recognized. And even though Diageo itself was only formed in 1997, which in reality is not that long ago, the brands behind Diageo have actually been around for a lot longer. Some of them actually date back over 200 years ago. And this means that these brands are established, they're known, they're loved, and this gives them pricing power. Also, given how established they are, they have been able to expand and operate in 180 countries. This means they have the infrastructure and networks in place to outcompete any competitors. Now, like I was saying, Diageo is a powerful dividend company. They pay dividends semi-annually, which means they pay twice a year, and this happens in April and October. They have a current dividend yield of about 2.17%, but they're actually considered a UK dividend aristocrat, which means they have been able to grow their dividends year on year on year for many, many years. And the ability of this company to grow their dividends even through times that were really tough for a lot of companies like in 2020 is absolutely crazy. Let me just show you this graph. Look at this. This is showing us from 2000 all the way to 2022. Diageo has just continually increased their dividend year on year on year. And I think this really speaks for a financially strong company. Obviously providing, you need to ask how they're funding that dividend, but this is really, really promising that they've been able to do this year on year. And like I was saying, they've done this in tough times. They've done it in 2008. They've done it again in 2020. Are they going to stop? Probably not if this is their track record. We see this with a lot of companies like McDonald's, for example, that have been able to just continually increase their dividends. And they become dividend kings and dividend aristocrats. And Diageo seems to be no different here. So let's just take a look at the performance of Diageo. So over the last 5 days, it's down. 1 month, again, it's down by 3.25%. 6 months, we can see that they've not had a great time, down by 9.18%. Year to date, 2.64. 1 year, again, we're seeing that they're down 6.11. If we start expanding it out past the 1 year point, we can see how powerful this company is. And if we max it out, we can see that they have had amazing, amazing growth. They just seem to be sort of bouncing at the moment rather than seeing any extreme upward growth. If we just look at Diageo's performance year to date, we can see that at the moment they're trying to rebound from this low that they had in January. They hit this low point and from there they have been going up, but they've not quite reached the highs of the year so far yet, which we're seeing here, 17th of January. And if we expand it out, the highest that Diageo has ever been, so the all-time high, came in on the 4th of January 2022, somewhere here, basically. I can't get it spot on, but yeah, highs were reached 4th of January 2022. So you could argue that Diageo is actually a little bit cheap right now. Perhaps it's a buy-in opportunity for some investors. But of course, you need to look into them a little bit more as you would any company. So I'm going to point out a few more things about this company, some things to do with their financials, and just to be fully transparent, Diageo is a company that I have in my own portfolio, but do your own research. Right now, a lot of companies have been releasing their earnings report, which is really, really interesting as an investor to see how they were performing, what the predictions for the future are, and just to see if anything's changed fundamentally in the company. And Diageo are no different. So just some points from their recent earnings call. Net sales went up by 9% across all regions. Operating profit was up by 10%. They have 80 million of free cash flow, and this is being used to grow the company. Yes, of course, they are using some of their money to pay their shareholders in dividends, but also a lot of this money that they're generating is being used to put back into the company and grow the company. For example, in January, they made the agreement to purchase a really super premium rum brand from the Philippines. I think it's called like Don Papa or something like that, but this just shows that they're acquiring new brands and they're expanding. They also pointed out that the North American sales are down right now, which of course isn't great, and there's factors that play into that. But they also did point out that Diageo are 36% larger than they were prior to the pandemic. So that just shows that they are growing quite rapidly. So let's just look at the financials behind Diageo, because that's really important. And I've just been using a website called Seeking Alpha. I personally have the premium version because it tells me literally everything I could need to know about any stock in one place. And you get like news as well, as you can see along the top. It's really, really cool. I will leave a link in the description, which is an affiliate link. If you do want to check it out, please feel free. But you can see loads of different things about the company, and it gives you definitions, which is really cool. If you're like new to this, you can actually see what different things mean. You get ratings, you get news, literally everything. But for the sake of not making this video really long, let's just jump straight into the financials of this company. So income statement, balance sheet, cash flow will tell you different things. But the first thing I want to point out is the total revenue. So you can see the total revenue here, and we've got data all the way from 2013 to 2022. And you can see that the total revenue pretty much has been increasing every single year, which is a really good thing to see from a company. There's been some years that it hasn't increased, like in 2020, from 2019 to 2020, you can see it dipped a little bit here, but then it just got back up and it carried on increasing. And with gross profit as well, we can see that it's had a similar picture. Some years, like 2020, it did dip, but on average, it's going up every year. And I can hover over gross profit and you can see that it's the income a business has left after paying all its direct expenses relating to manufacturing of a product. So that just gives you an insight as to why you would care about gross profit, and you compare that to total revenue and other things listed here. So going down to the operating income, I don't know if this has got a definition. Yeah, it does. So operating income, the sum of the company's profit after subtracting its regular reoccurring costs and expenses. So these are going to be things like wages, things like that, any operating costs that they have that are ongoing. So they're regular, they're not a one-off. So we can see that operating income, on average, again, some years aren't going to show this. Obviously, every single year is not going to be an increase necessarily, but on average, it's a strong thing to see that this company is increasing their operating income year on year and on year. So going back up to the top and just switching over to the balance sheet, you've got all these different things here that you can change should you want it in British pounds, which would probably make more sense for this company in particular, but I forgot to change it, so we're looking in dollars. But all I'm trying to point out is increases and decreases, very high level stuff at this point, so it doesn't matter too much what currency they're in. What I wanted to point out here is the liabilities versus their assets. So just taking a look at their total current assets, and let's just look for let's go across here, 2022. So here you go. So their total current assets in 2022, and then I want to compare this with their current liabilities in that same year. Here they are. So what we can see, and this is the same for most years, and we've got long-term liabilities as well that you could look into, but what I wanted to point out is the total assets are bigger than the total liabilities. As I was saying earlier, I think Diageo have a strong economic moat, and two indications of a company having a moat is that they have strong margins and lots of cash generation. Diageo has very high rates of free cash flow. They're like a cash generating machine, if you will. Also, looking at return on capital employed, which is a financial ratio that we can use to basically give us an indication about how well a company is able to generate profits from its capital But Diageo is very strong here. Again, there's another thing called return on equity, which is a measure of how well a company is able to actually make profit from their assets. And Diageo sits at about 45%, which is a lot higher than a lot of their competitors. So that's a really good sign as well. I realize that this video so far has been very, very positive about Diageo, and that's just because they're a great company and there's a lot of positives to say. But one thing I will say about them is they operate with a lot of debt funding. So as an investor, you may just want to deep dive into that a little bit more. Okay, so the next company that we have today, a discounted stock in February, is AstraZeneca. AstraZeneca is a global biotechnology and pharmaceutical company, and I'm sure you've heard of them. I should just use this time to actually point out that there are a lot of pharmaceutical and healthcare companies that have been performing not very well recently, that are on a bit of a downward trend. You've got Johnson & Johnson, you've got Pfizer, GSK, Unilever. They've all been performing quite similar to each other, but I just picked AstraZeneca for this video. So they pay twice a year, just like we saw with Diageo, semi-annual dividends, and their dividend yield is 2.3%. Okay, so back on Seeking Alpha, they have this dividend section, which then gives you the ability to see loads of different things about the dividend yield, the dividend growth, safety, everything. But let's just have a look at their dividend growth. So if I scroll down, you can see loads of data, and they also give it a score. But anyway, what I'm interested in is the dividend growth here. So I'm going to expand it out to 10 years. And what I wanted to point out here is that they have been keeping their dividend the same for many, many years in a row. And if you want to see it charted out here a little bit simpler, you can. But look, you can see here payment amount. It's sat at the same for a long period of time. Oh, that wasn't very good. But here, all the way up to here. They didn't decrease it. They haven't been cutting it, but they have been keeping it the same. So it's not really been growing exactly. But what you can see, 2021 to 2022, look, increase. And you can see it if you hover over as well. Look, you can see it all the same. And then we've got a bump up here. And also, actually, on Seeking Alpha, you can see if there's any stock splits and what the split was. So this was a 2-for-1 split, which happened in July 2015. Looking at the performance here, we can see that 1 month they're down by 9.32. 6 months down by not as much. They had a bit of a rebound here, but 1.27. Year to date, 7.27. 1 year is a bit of a better picture, and then obviously if we zoom out we can start seeing what's been going on over the long haul. But I don't know if you're going to be able to see this. I might be able to zoom in, but what we can see is that very recently there's been a bit of a dip here, which could be a good opportunity to buy this stock should you believe in it over the long term. You know, you may be getting, let's go back to 5 years, you may be getting a bit of a discount here than if you were to buy up here. But you also could argue that if this is a long-term hold for you, it's not really going to make that much difference. But still, personally, I do like to look for when there's an opportunity and perhaps take it. But again, I don't think it's like really, really necessary. It really depends on your investing strategy. Okay, so we've taken a look at the performance of AstraZeneca. We've seen that they've been going down and pointed out that it may be a buy-in opportunity. But I just want to point out some more things about this company. The first thing that I want to point out is their rising free cash flow. And now this allows them to create a bit of a financial cushion. It means that they are also able to pay out their stable dividend twice a year, and they can look to expand their business as well. Talking about expanding their business, AstraZeneca actually recently took advantage of a crash in the share price of a US biotech company. I think the company's name is Syncor. I'm going to put it on the screen because it's literally just like wiped from my mind. But yeah, anyway, they agreed to acquire this company. And even though this is the most recent acquisition, it's definitely not the only one. Beyond their expansion plans, another positive that I wanted to point out from AstraZeneca is their global diversification. And what I mean by globally diversified is that they have global sources of revenue. So what you can see here is they're not overly exposed in just one region. 42% of the total revenue is coming from the US, nearly 20% from Europe, but you can see that you're getting a lot from the emerging markets, rest of the world. You're getting revenue from all these different places. So that just means that should one take a knock, the company is still able to get revenue from the other streams. And that's really, really nice to see. As an investor, revenue streams are quite important in my opinion, not just geographically, but also do they have lots of revenue streams? Like if you look at Apple, for example, going off on a bit of a tangent here, but you'll notice that Apple's revenue streams aren't just the iPhone. You know, you've got Apple services, you've got all the different products, very, very vast revenue streams. And that's really, really important for a stable business. And AstraZeneca is showing us a bit of that here in terms of geographical diversification in their revenue streams. So back to Seeking Alpha really quickly, just to look at the financials. So we're going to just take a quick look at the income statement, the top line, the bottom line, but of course do a deep dive into any stock before investing. So has total revenue been increasing year on year? Pretty much. So it dropped here slightly and then it started picking up again and it's been increasing, quite a big increase here. And gross profit, has that been doing a similar thing? So slight decrease again between these years and then picking up and picking up. So yeah, that looks good, but you'd have to look at the debt. Also Seeking Alpha tells you different like ratios and financial things that you want to know. So payout ratio, EBITDA, which you can just hover over and it will let you know what that is. You can see their long-term debt. Everything you want is pretty much here. And you can also go into like the earnings of the company and stuff like that. So you can see last quarter's earnings, which are really, really interesting. Loads and loads of information. One thing to point out about this company in particular, AstraZeneca, is that they're relatively non-cyclical by nature. Whether the economy is performing well or it's not doing so well, the demand is still there for medicine regardless of the situation. Even though the stock performance of this company hasn't been doing too well recently, some hardcore value investors may still argue that the company is actually overvalued. They currently have a PE ratio of about 96, which is a lot higher than other competitors like GSK. If you're interested in joining my Patreon and my Discord channel, then I'll leave a link in the description. Please consider it. It's really fun. We talk about all things to do with investing and personal finance every single day. But yeah, other than that, thank you so much for watching and I'll see you in the next video.